All right, so today I wanted to do a Canadian stocks update. First things first, as usual, if you get value out of this video, please like and subscribe. I really appreciate that. So we've had some stuff happen since the last time I made a video on Canadian stocks. I think it's been a month or two since I've done that. And the first one is EQ Bank. And EQ Bank is over $100 a share. I believe it's touched about 104, looks like. Actually, 105 exactly was its high. That was back on Thursday, it looks like, or this past Thursday. And well, the last time I brought this up, I remember saying that I think EQB is worth about 110. I think I might have said 115, but I remember 110 a share. And if we look at its valuation here, it's above its historical PE now, but it's below its historical price of sales. But you also have to keep in mind that it has below a 9 PE. And as I always point out, if you look at like a TD Bank, theirs, I believe, is over 10. Let's see. Yeah. Actually, right now it's 19. But the 5-year average is 11. If we look at, let's say, an RBC, or I think it's just... The ticker is RY. I just forgot the ticker there. So again, if we look at Royal Bank, they are the biggest bank in Canada. Theirs is just under 15, and the 5-year average is about 12. So I think that EQB probably commands it should have probably a 10 PE. I mean, that might even still be conservative. So at these levels, I think that we're probably talking about fair value. Maybe it's a touch undervalued. I still maintain that 110 to 115 price target. Does that mean that it's undervalued? Yes, because it's below that, but it's not as good of a deal as it was back when it was in like the high 80s, low 90s when I first brought that up. And I mean, I've been talking about EQB for over a year, and my original shares that I bought on that have a cost basis of like $47. It's in the 40s. I don't know what it is, but obviously up over 100% on those original shares, and that's the majority of my position there. So very happy with that. I distinctly remember it correcting down there and be like, man, I gotta buy this. And the problem was I only bought about, at the time it was maybe 5 or 6% of the portfolio. Again, following traditional investing rules, that was the right thing to do, but I wish I would have bought more. So that is EQB. The next one is ATD, and this one this is another one that I like. It hasn't done nearly as well as EQB. In fact, it might even be down on the year. Let's check and see here. Yeah, it is down on the year, not by much, 78. It's just over 75 a share right now, but recently, I think it's came down because they tried to make a big acquisition, which fell through. Am I concerned about them over the long run? Absolutely not. I still like them. The problem with them is, I mean, if you look at their historical valuation, I mean, they're above all of their historical valuations. I mean, based on PE and price to free cash flow, they're above that by quite a bit. So even though they're down on the year, that doesn't necessarily mean they're a buy. I remember saying in the past, I think you could buy them around here, but now that they're around there and I look at their valuations, they're definitely not a buy right now. This is one that if you have a position, I think it's a hold. I think that it's a very obvious hold. I think it's going to have to go down to probably 60, 65 a share, at least based on current earnings, for it to be a buy. Over the long run, I still think they're going to be okay if you hold them. I wouldn't even think about selling them right now, but they're definitely not a buy. But I think they are one of the best Canadian companies out there. That's why I own them and why I watch them. The next one is Dollarama, and this is another one that in the mock portfolio I bought a little bit at 101, and I wish I would have bought more. And I've been buying this company. I've been slowly dollar cost averaging for about a year now. And my cost basis is probably like in the mid 110s, and it just keeps this is a stock that just keeps going higher and higher. But if we look at its valuation here, it is well above its historical valuation. Now, do I think that it's grossly overvalued? Honestly, I don't think it is. It definitely is overvalued, but is it 20-25% overvalued like this implies? I don't necessarily think so, because this is one of those really underrated businesses that I really like. I don't think it's a buy where it's at right now. I think probably like 120, if I'm just going off the top of my head, is probably about fair value. So it definitely is overvalued, but this, again, is another one of those businesses that I think is really good. And you have to keep in mind that this is like their margins, I think, are better than like your typical grocery stores, right? I mean, look at their revenue has doubled over the last decade. Their shares outstanding have gone from 385 million to 284. Earnings has gone up like 3x. If you look at their metrics, free cash flow margin 21%. I mean, a decade ago it was like 13, a little less than that. Free cash flow per share has gone up like 4x. So this is a business that's still growing very good. And I think that with Canada's population that's just exploding, and on top of that, people are having a tough time getting by, this is a business that I think is going to continue to benefit from that. So this is one like ATD that I would have at the top of my watch list, and I have those price targets ready to go. If it hits that price target, I would definitely be pulling the trigger on this one. The next one is Brookfield Asset Management. This is one that I have maybe like 2%, 2.5% position in this company. It doesn't really have a valuation, at least right here. I think it's probably a little bit overvalued where it's at right now. This is just me gut feeling. It's basically right at a 52-week high. My price target for this would be like the low 40s. I remember buying right around that 40 level, and it's been there recently. I mean, it's been there as recently as August. So this is one that another one that's definitely for a watch list. Solid company. They're one of the best dividend growth names out there. I mean, over the last 3 years, they've been growing their dividend 42% per year, and that's on about a 3% yield. And I think that this is a company that probably will grow 20-30%. So that's why I'm buying it. I definitely won't take a full position in it. I'll probably get it up to about 2.5-3%, and then just reinvest dividends. The next one is Brookfield. Another one that's kind of hard to wrap your heads around. Another one that I probably will only get up to, I'd say 1 or 2%, because it's kind of a hard business to evaluate, for lack of a better way of putting it. But they do have a really, really good track record, and that's why I do have a very small position. Constellation Software is the next one. This is one that I've had on a watch list for probably a year and a half, if I'm just guessing here. It's never gotten cheap enough, and it might never get cheap enough. That's something that a smart investor will be okay with, that there's going to be a lot of businesses that you'd love to own, but you're never going to buy it because it's never going to be trading at a good valuation. Maybe it's like a once-in-a-decade thing, but there's some that might never fall into that category. And a price of free cash flow of 35, a PE of 107, that's just way too expensive. If I could get it for a price of free cash flow below 27, I'd take it. If I could get it for a PE below 40, 35, that's still expensive, but I'd probably consider it there. That's where I'd consider it. But they're way too expensive. So this is another one. Keep on a watch list. Be ready to go if you get a nice large correction, but you need to be okay knowing that might never happen. The next one is an oil and gas name, and probably my favorite Canadian one, at least. There's some smaller ones that I think is more of a speculative play that you'd want to buy if you want to maximize returns. But this one is, of the ones that are more well established, this is my favorite one for many reasons. If you look at their yield, their earnings yield over 8%, free cash flow yield over 11%. If you look at their dividend here, they're actually increasing the rate at which they grow it. And the payout ratio is just over 50%. They're growing at 30% per year over the last 3 years. Are they going to be able to maintain that over the next decade? Definitely not. But can they maintain the 16% they've done over the past decade? I think that's reasonable. And that's one of the many things that I like here. If you look at their metrics here, And another thing that I didn't mention there is that they didn't cut their dividend back in 2020, which a lot of oil companies did. In fact, most of them probably did. And that's something that I think is an example that they're managed very well. And that's one of the many things that I like here. If we look at their metrics, their profitability metrics, I mean, back in 2020, the free cash flow margin was still 12%. They're 20% this year. They were 33 in 2021 and 2022. So they're very profitable. And the fact that they still made money with relative ease back in 2020 points me to believe that I think that this is a company that's worth owning. And if we look at growth over time, they've done well. Their balance sheet, the current ratio is just under 1. I'd like that to be a little bit higher, but it's not necessarily concerning. If we look at their historical valuations, they're significantly below their historical PE and price to free cash flow. Not by a ton, but definitely a little bit. So of all the companies on this list, this one probably is the one that screams buy the most. Do I think it's grossly undervalued? No. I think fair value is probably in that 35 to 40 range, probably the high 30s. Mid to high 30s is probably fair value right now. Anything under 40, I would probably be okay buying if you want to take a long-term position. So this one is the best buy right now. Does that mean that you're going to do... Oil is one of those things that you definitely need to be timing the market to some degree when it comes to oil. But does that mean that that's all you do? Not necessarily. I think oil is going to trend up over the next decade or two. It will go away at some point, but nobody knows when that is. The one thing that I'm rather certain of, it's not going to be over the next decade. So anyway, that is my thoughts on the top Canadian stocks. Like I mentioned at the start of the video, if you got value, please like and subscribe, comment, all that good stuff, and stay tuned for more.